Jim Cagnano with Infinity Futures. I'd like to welcome everybody for being here today, taking time out of your busy schedule, especially during what's mounting up to be a fantastic trading day in the futures markets, and we'll talk about why that is. As you can see, the E-mini S&P ladder on the right is making new highs just about every time we blink. So we'll talk a little bit about that as well. Infinity homepage, not much to talk about here. We'll get back to that later. I do want to talk about risk. Trading futures, options on futures involves substantial risk of loss, not suitable for all investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although that could be an equation for happiness, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition, money I can afford to lose, doesn't change, doesn't lengthen my retirement horizon, change my lifestyle, or overly anger Mrs. Cagnina. And I throw that third part in only partly tongue-in-cheek, because stress in life does matter, and a stressed out trader might make some bad decisions. So be in a good place and understand the risk-reward proposition in futures, and we're going to talk about that in pretty big detail today. You get an awful lot of leverage in futures, and leverage is a double-edged sword. It could work for you as well as against you, so be careful. If you're not sure where you fit on the risk capital curve of things, give me a call or give one of our customer representatives a call. Everybody's assigned a personal representative, whether you're a customer or you're just kicking the tires and going through the discovery process of whether Infinity Futures is right for you or whether futures trading in general is right for you. Feel free to have that confidential conversation. Everybody here has been involved in the futures markets for a very long time. The reps are all NFA members, CFTC registered, passed a rigorous Series 3 examination, and have spent, 10 plus hours every day for a long period of time interacting with the markets as well as traders like you. So feel free to use that low pressure sales shop here. There's no pressure here. This is a tough business to be in. We want to make sure it's right for you. So if any questions on risk, type those in. Let's get one last confirmation that everybody could hear me okay and you can see the screen okay. Just haven't had a comment since I started talking, and that sometimes is a warning. Here we go. Okay, everybody's cool. All right, so we do have a lot of non-futures traders in the room today, and so we're going to cover some basics as well as some more advanced stuff today. And so mostly we're going to be looking at the chart, we're going to look at the trading ladder, and we're going to talk about what it all is and why futures trading, in my humble opinion, especially if you're a day trader, is more advantageous than doing other types of securities, equities, or over-the-counter types of trading. There's a lot of benefits to talk about. And the first benefit, let me just pull up really the first thing that comes to my mind is the fact that these markets are open almost 24 hours a day. I'm going to go back in time a couple of days here on my chart. Bear with me while I get this all situated. And we are going to take a peek. I want to go to a 30-minute chart. Really easy to do on the Infinity AT charts. And let's see, where was my, wow, look at that. There we go. This is what I'm looking for. My goalposts. For those of you in the U.S. know what that means. You probably know what it means anyway. These are web-based charts. They work on any device virtually, Macintosh, PC, whatever you want. You could trade from them. You could do all sorts of technical analysis from them. We'll talk about them in more detail. So 24 hours, what does that mean? Here's a picture I drew from a couple of days ago. This first solid yellow line here represents the close of the New York Stock Exchange, or the New York cash market, you could call it. The futures trading market continues on. This is the E-mini S&P. which is one of the most liquid, one of the most popular markets that folks like to day trade. It's equivalent to if you trade a SPY ETF, and we'll talk a little bit more about that in a minute. This dotted line represents the start of the night session in the E-mini S&P, right? So it's I have a dotted line here, and it's 5 o'clock Chicago time. I'm going to talk in terms of Chicago time. It's Central Time, CST. 5 o'clock Chicago time. And this whole distance between these two dotted lines, I would consider the night session. The second dotted line over here is when the cash market opens up the next day. The cash equity market opens up the next day. And I'm using the stock index market as an example because it's the most obvious one. And in this example, this pattern holds true to all of the other types of asset classes also. But with nearly 23 hours, we only have from 4 o'clock to 5 o'clock in the afternoon where the exchange is actually closed. So this period here, you can't really do much if you wanted to in other markets. In this market, you could do this exact same thing you could do in the daytime. And you could see, that if let's just track it, market opens up and we had a pretty big rally for some reason at 5:30 or, the 5:30 candle. Again, this is a 30-minute chart. And we, the open was at 30.75, the close 30.83. That's an 8-handle or 8-point range. Each point, of course, is worth $50. So that was a pretty big move right there that you wouldn't have been able to capture, or you wouldn't have been able to participate in were you trading regular equity markets, regular ETF markets. So whatever the event was, we rallied. We had some sort of sideways action during the night, and then Europe opened up and provided some more trading opportunities, right? So this is really a global marketplace from an institutional standpoint, from a commercial standpoint, and from a retail. And when I say retail, I mean regular traders, right? Regular guys like me and you. And when I say guys, it's unisex. So please don't send me nasty emails saying you said guys instead of gals. But so you have real ability to do technical analysis based on real events that are happening in the world, whether it's related to China tariffs, whether it's or maybe China PMI numbers coming out that night, or whatever it is. Brexit is also a big driver that people are paying attention to when us in the U.S. are sleeping. So the 23-hour nature of this thing provides a huge advantage. And as an example, today, and I just learned this a couple minutes ago, is the busiest day of the earnings season. There's over 420 U.S. listed companies that are set to report their earnings today. Now, some of them are reported during the course of the regular business day, and some of them are reported what's called pre-market, right? Pre-8:30 Chicago time or pre-9:30 New York time, and some of the earnings announcements are actually after the market closed. So this is another type of events or information that we know is coming and that we could position ourselves for and take advantage of. And if you look at the mini NASDAQ market, and we'll talk about the mini NASDAQ market more, and you look at the FANG stocks, Apple included, there could be some real impact on a NASDAQ index where there's only 100 companies represented instead of a large cap E-mini S&P where there's 500. And then Dow Jones, Diamonds, it's another one. So the ability to take advantage, put stops in, put limit orders in above or below in non-traditional trading hours, or times when maybe you are going to go to bed eventually. I know I sometimes do, and you could always express an opinion at night through limit orders, and of course you'll have a stop in also that will be at the exchange itself, and you can go ahead and do that in the hopes of getting some sort of action at night. So that's kind of number one is the 23-hour nature of this market. And in most of the CME group markets, we're going to focus on those today, they're pretty liquid. In other words, the bid-ask spread is pretty tight and there's a lot of activity going on, so they're very tradable. Sorry about those little pop-ups. Hopefully you're not seeing them. All right, so that's kind of number one. I'm going to any questions here, let me know before we move on to the next. I lost my question box, of course. Okay. I'm going to hit this fast forward button and come up here. The other thing that, let me just show you, actually, let me do this. Here's kind of the laundry list of things we're going to talk about. Trading around the clock, we just talked about. Trade with a low account minimum, we're going to talk about next. Tremendous liquidity and notional value, that's very important. That's the notional value is the cornerstone of the leverage conversation that you have with respect to the futures contract. Sell short anytime. Futures orders are filled on a first come, first served basis at one transparent exchange. We'll talk about that. Futures profits may have preferred tax treatment. Futures orders are sent directly to the exchange. They're not routed. There's no ECN model here. You get more bang for your buck, more efficient use of your capital. And I added, don't let the bid-ask spread take all your money. The bid-ask spread in the futures markets are determined by the participants in that market. It's determined by the global community of buyers and sellers and this constant struggle of bull and bear and constant struggle of long and short. And this liquidity tightens the bid-ask spread. And we'll take a look at what a bid-ask spread is and how it could affect the cost of your transaction. And then finally, great technology. I mean, across the board, Infinity AT Trading Ladder is spectacular, and there's some other okay trading platforms also. But on the futures side of things, the technology, in my opinion, seems a lot better. Seems a lot better. All right. Let me manipulate my windows. We are using GoToMeeting and GoToWebinar, and they do have a tendency to actually pop up a whole, for the presenter anyway, pop up a whole bunch of windows that get in the way of things. And I'm going to have that question box back up so I don't miss anything. Bear with me a second. Okay. Thanks. All right, when I say trade with a low account balance, what does that mean? Let's take a look. I got some notes here. We're not going to do a lot of notes. I had a PowerPoint and I scrapped it. Like we're going to get into some trading strategies. We're going to get into some trade ideas and take a look at the real power. And the real magic is the trading ladder and the prices 10 ticks deep. But you don't have to be a pattern day trader, whatever that is, to trade futures, right? So you don't need you don't have to have $25,000 in your account in order to do this. As a matter of fact, if you're brand new to this, my suggestion might be, hey, maybe you could tone it down when you first start until you get the flow of things, until you get the hang of things, and then you could, go ahead and deposit your appropriate risk capital. Alternatively, folks with more risk capital could also, use that capital in a more efficient manner and fund their account with whatever they're comfortable with. So, but for as little as $3,000, that's the minimum here at Infinity, you'll have access to most of the futures markets and be able to day trade. If you want to trade the new micro mini stock index futures, which might be a good starting transition from sim trading to futures trading, then with $1,000 down, you can go ahead and get involved in the micro mini stock index futures, and we'll talk about those also today. So most of this is about pattern day trading, and you're not required to meet the $25,000 minimum. And even with the smaller deposit, if you choose to make a smaller deposit, your buying power is still greater with futures. We'll take a look at what that means also in a second. So that's kind of advantage number two, right? You not only we'll get into a more efficient use of capital in a minute, but you have more bang for your buck, and we'll expand on that in a couple seconds. All right, any questions yet? Just feel free to type them in. Liquidity and notional value. Before we even talk about, let me introduce it this way. So if you wanted large cap exposure, large cap stock index exposure, you would look at the S&P 500 stock index, right? The S&P 500 stock index is a large cap stock index that's very popular, widely followed, and you could have access or exposure or trading opportunities to that index a couple of different ways. And two of the most popular ones are through, the SPY Spider S&P 500 ETF. Or SPY. People call them spiders or SPYs, and they're really equivalent to the E-mini S&P 500, which we see here, or its little brother, the micro E-mini S&P 500. Okay, if you wanted to have exposure to tech stocks, you could do the Invesco QQQ ETFs, or the E-mini Nasdaq 100, or little brother, the micro E-mini Nasdaq 100. Blue chip, again, diamond ETFs are the same as the E-mini Dow or the micro E-mini Dow futures. And small cap, if you want to get into the small cap benchmark stock indexes, you got the Russell 2000 ETF, or the Vanguard Russell 2000 ETF. I mean, you got multiple options. Then you got two times leverage, three times leverage. The ETF market has kind of created all these products and derivatives of products to generate interest and generate volume, and of course generate money for themselves. Or you could trade an E-mini Russell 2000 futures index. It tracks the Russell 2000 index. And this extends past just the stock index benchmarks. I mean, you could do a GLD ETF if you want, or you could do gold futures. There's silver ETFs. There's ETFs on everything, but there's also futures on everything. And for reasons that we'll continue to talk about today, the futures are almost always your best bet. So let's I'm not going to get a calculator out, but yesterday the E-mini S&P volume was, I don't know, over 1 million. I have written down here 1,076,000, and that's just tracking the December contract, which is the front month, which is the popular contract, which is what we're looking at here on our screen. So over 1 million contracts was the volume. And if you remember, the notional value of an E-mini contract is simply the price of the market, right? So you would take 3,093 and 3/4, or round it up to 3,094, and you'd multiply that by 50, right? Let me see if I could just quickly get bear with me here. I'm going to quickly get a calculator out to kind of, let's do the math together. So let's wait for my calculator to pop up here somewhere on my screen. I have to find it behind all the GoToMeeting windows. So a notional value, how big is the contract that you're either going to go long, you're either going to buy, or you're going to sell? Let's just take 3,094, and we'll multiply it by 50. That's the multiplier. Each point is worth $50, remember. So 30.94 to 30.95 is $50 per contract, right? So the notional value of this contract, you could say, is $154,700, or you are controlling $154,750 worth of S&P stock index. That's the value. That's the value of that position for one contract. And if you have two contracts, you'd multiply it by 2. If you had 10 contracts, you multiply it by 10. The math is straightforward on that. Now, if we decide, hey, let's just say the average. Let's backtrack a little bit here, and let's say the average price yesterday was, I don't know, say 30.75, and we'll multiply it by our 50 again, right? And then we're going to multiply it by the volume. Let's multiply it by 1,000, by 1 million. Million. What did I say the number was? 1 million. Well, let's just round it down to 1 million. Okay, and then I'll hit the equal button. We have 153 billion. Okay, you have 153 billion in notional value. Now, the SPY on average, just to put this in perspective, only trades 18 billion. Now 18 billion is a big number for sure, but it only trades 18 billion on average a day. So it's 18 versus 153. So there's a whole heck of a lot more market power here. If you look at the volume, the notional value of these contracts, and the same analysis applies to just about all of the futures contracts. When you look at some of the more traditional over the counter or even exchange traded types of instruments on the cash side, on the non-leveraged side, futures trading is leverage trading, right? Okay, so and then if you look at Forex as an example, if you're in the U.S., you don't have the same advantages of over-the-counter Forex as you do if you're in some other places in the world. But you're limited to, I think, a 50-to-1 leverage, or about 2% of your margin requirements on a over-the-counter Forex market. Here on the future side, let's just pull up the euro futures. Euro FX futures, you're at 250-to-1 leverage because you have it's a $125,000 contract. So we would go 6EZ for the euro, and we'd pop up a chart, and all of the advantages trading this market applied that the same as with the ES, right? 23 hours, you have the leverage, you have the liquidity, you have the tight bid-ask spread. So this is the 6E, the Euro FX, and this is the futures version of this thing. So so there's that size advantage also on the future side. Any questions on leverage or anything like that? Type it in. And so from a volume point of view and a liquidity point of view, you have a tremendous amount of activity, a tremendous amount of participation. Now let's look at a futures. I'm just going to you know what, actually let's use a NASDAQ for this. Let's use the mini NASDAQ for this. I'm just going to pull up a ladder. This is a trading ladder. Most of you guys are familiar with it. You see the price ladder in the middle. There's all the prices here. The dark blue line going across, that's where the last transaction occurred. That's mark to market. That's the market moving. The numbers in the blue are limit orders to buy. I'm on a real-time simulated account, demo account right now, but the data is real time and the bid asks are real. So this is exactly what you'd see if you logged into live mode, only the background would be gray instead of light blue. So in any event, if we were to go ahead and let's just say we want to buy a mini NASDAQ at the market, we'll hit our buy button there, and it reminds us we're on a simulator, the very first trade we make. And we're long one, right? We'd be long one at 82.62.5. You can see that we've got that indication there that we are. That's where our position is at, and at the bottom it shows the mark-to-market value of your position based on where that blue line is going across, based on where the market's trading. It's what it basically infers is, hey, if you were to get out of this position at the price at this exact price at 82.61.5, now 82.61.25, now 82. See, it's moving quick. That's what your P&L would be down here. So we're negative, we're down, the prices are below where we bought it, right? So that makes sense. Now, the point I wanted to make here is if I decided I want to sell this position. I don't want to have an open position. I don't want to be +1. I'd rather sell. I'd rather be short instead of long, right? I'd rather be short instead of long. So I would try to get out of this. I'm going to just go ahead and sell one at the market, right? To basically sell back the position I bought. So I was long and now I'm flat, zero position. Now I could immediately turn around. I don't have to wait for settlement. I don't have to wait for anything. I could just go ahead and sell one immediately like that in no time at all. So when the immediacy and the ability to pivot and the ability to um, move along with the market is fluid, liquid, and instantaneous in futures. Your account has a certain amount of capital in it, and you've been enabled to day trade a certain amount of contracts per market, and the system behind the scenes knows this, and it's able to accommodate this type of trading. So, and I know you guys who are futures traders or customers here, I'm probably boring you a little bit, but there's a lot of folks who have not traded futures before and don't understand this. Okay, you're not somewhere lost in space waiting for your funds to be able to be freed to actually go ahead and engage again and to participate again. Okay, so and that was just I just did a random buy and a random sell and another random sell. Now the other thing you could do, which I think is equally is fluid and equally as beneficial, is the ability to scale in or scale out of a position, right? So right now we're short one, we're minus one. We say we're short one. Our opinion right now is the market's going to go down, and we want to go ahead and buy one back at a lower price for a profit. And I just put a limit order in just to demonstrate the purpose there. Okay, so if the market does in fact go down to here, then this is awesome. I'm literally I'd make some money. If I wanted to put a stop in, which of course you do, whenever you have a position, you're going to have a stop. You're going to put a stop order in there, right? And if it goes up here and we get to 82.64, I was wrong in my opinion, and I lost money. My analysis wasn't, for whatever reason, it didn't work. So this is like the anatomy of a typical trading ladder trade, and it's quick, it's fast. And then the reason I did the mini NASDAQ is because it is traded in smaller tick increments, right? $5 tick increments instead of the $12 on the E-mini S&P. So it gives us better. It gives us a better way to do a demonstration in the short amount of time that we have today. That's all. Okay, so but it gets even better than that. Let's say I'm going to cancel this stop. I'm going to cancel this, and let's say, hey, I want to go short another one. I want to go short another. I want to average in a little bit. You got to be careful with this technique, but you could do that, right? So I want to go ahead and, I don't know, sell another one at a different price. And then it would give me the ability to be, when I sell this next one, I'll be short 2. So now I'm minus 2. I have 2 contracts and everything's doubled, right? The tick value is doubled. It goes from $5 to $10 because it's times 2. And then when I'm going to go ahead and put my target in, I'm going to put it as a 2. When I put my stop in, I'm going to put it as a 2. Right, so I want to I want to either take profit here or I want to get out if I'm wrong, or another thing I could do. I'm going to cancel that, and I'm going to say, listen, I want to take profit on one. Oops, my bad. I want to take profit on one at this price, 60 3/4, and then I want to take profit on another one down lower at 59 even. So this is the ability to split up orders, to scale in, to scale out, and to pivot, and to do a different type of trade altogether. It's infinitely cool in my opinion. It's the software, the technology. You don't have to wait for funds to clear. The bid-ask spread, as you can see, is right now it's pretty close to one tick, the smallest it could be. We'll zoom in a little bit on bid-ask spread in a second. And I'm comfortable knowing what's going on. And not only that, these orders are at the exchange. When this comes back on your trading ladder, now I'm in the sim mode, so it's not really at the exchange, but if this was a gray background, this order would come back. This order, you'd see this here, this is resting at the exchange. So if your computer goes down, your internet connection goes down, whatever it is, this order's at the exchange. Now, we just went ahead and we got one. We took profit on one of our units, and you can see on the bottom right here, on the bottom right, it's 30, right? We made 30 on that unit. We still have open trade equity of 30. This is gross P&L, but our stop is wrong, right? We got to change that. We got to make that just a 1 lot now, right? And in this particular trade idea, if you put your stop to break even. This is one trade strategy, then you have kind of almost, if you think about it, a free trade, right? You took profit on one of the units, and now you can let the second one go. And if you get stopped out here, and I did it break even +1, so I get my commission back, break even +1, so I get my commission back, then it's okay. I feel good about it. You can't, okay, I got stopped out. I didn't make it. I'm going to go ahead and right-click this order. I don't want that dangling anymore. And that was an anatomy of a 2-lot trade that we scaled down to 1 that we got out at. Okay. Frank, yeah, now you could go do it again. You could do it again. You could do it again. You could do it again. So, I mean, what I'm doing here is just random demonstration on order entry techniques and on the efficiency of the Infinity AT Dome. We're going to talk about strategy today also. So I'm just going to go ahead and cancel all, flatten all. Let's get rid of the mini NASDAQ. All right. Let's take a look at, all right. Futures orders are filled on a first come, first serve basis. FIFO. That means that it doesn't matter who you are. It doesn't matter how big you are. It doesn't matter how small you are. When you place a limit order, and let's take a look at this this trading ladder here on the right-hand side, the E-mini S&P. You get in line, right? If you want to buy a contract, let's pick a price of 30.90 and a half. There's 364 contracts already in line. I'm going to click once, and I'm another one. I'm at the end of the line. Okay, and that number changes. People cancel orders. They put them in different prices. People add to the orders. So this number is always dynamic. It's always moving, but I'm still in line. There's still a certain amount of contracts in front of me. And if the market goes to that price and we start having transactions at 30.90 and a half, then that line shortens, right? You're waiting in line for for whatever, at Starbucks or wherever you're at, and as you get to the front. As you get to the front of the line, no one's going to cut in front of you, right? And then, sure enough, once you're the next one up in line, and somebody willing to sell you one at 30.90 and a half, then you will get your fill. You will then be long at 30.90 and a half. Okay, so that's what I mean by first come, first serve. Market orders, same way. You set a market order, and you're going to get the best available price. If it's a buy market order, you're going to get what the lowest offer, right? Offers are on the right, or asks. Offers on the right, bids on the left. If you're going to sell at the market, you're going to get the highest bid. And you can see it's moving around pretty quickly, which is another indication that you're looking at a good market. You're looking at a market with a lot of volume, a lot of volatility. Market order to buy, you get the best available offer in the red column, the lowest available offer. Market order to sell it, you get the best available bid, or the highest number in the bid column. Okay, so it's fair, it's transparent, you can see everything. The exchange gives you a order ID number if you really want to go crazy and start tracking things. It's a legitimate method at a centralized exchange. One place in the world trades the E-mini S&P. It's not an ECN model that we talked about before, where orders are routed from different places to different places in different liquidity pools. Doesn't happen in futures. What you see is what you get. Okay, moving on. I think my next bullet point was futures profits have preferred tax treatment. So there's a blended, in the U.S. there's a blended, you got to check with your tax accountant, but there's a blended rate for futures profit. It's 60% long-term capital gains, 40% short-term capital gains. So it's a blended approach. If you're day trading equities, you're going to be, you're going to be taxed as ordinary income if it's a short-term trade, which is less than a year in a day. I know it's a year and a day because one time I got out of a very profitable position after a year thinking, okay, now I have a short-term gain, and my account said, no, it's a year and a day. So I totally I could have hung tight. I should have hung tight one day. I would have probably captured. I would have made a lot more money. But so it's short term, long term, and that blended rate again. Check with your tax professional or preparer. But the general consensus is the blended rate gives you a advantage over just a regular short term equity trade or ordinary income instrument, I should say. Futures orders are sent directly to the exchange. We already talked about that. More bang for your buck. Let's talk about that for a second. So remember, leverage is a double-edged sword. It could work for you as well as against you. But really, the best. This opened my eyes up. Here's a mini Nasdaq, and you could have $500 day trade margins with infinity. In other words, if you meet the account minimum, and then you want to place a trade in the mini Nasdaq, with a day trade, there would be a $500 margin commitment on the capital in your account. Now, if you wanted to do a similarly sized, let's say you wanted to buy Apple stock instead, you would have to, last time I calculated it, you would literally have to buy 600 shares of Apple to have the same exposure as one contract in the E-mini Nasdaq. So it's not a fair fight. It's not a fair fight. You get way more bang for your buck. So you get a more efficient use of capital. Now you got to use your leverage cautiously and wisely, but you do have that more efficient use of capital. So I'll show you another trick real fast. You could put a stop loss in and a profit. I know I'm kind of diverging from the idea here, but I'm going to go ahead and manually add a bracket, right? So I'm long one. I bought one at 59 3/4. I want a profit target of 16 and a stop loss at 9. And it automatically places both legs of the trade. Again, this technology is really, really good. It automatically places both legs of the trade. And then hopefully, if we get lucky enough to see it hit 63.25, we got lucky, we got out. And then it automatically canceled the stop. That's called OCO, order cancels order. Or order cancels other. If you're old like I am, it's order cancels other. But if it's commonly referred to as order cancels order. So that's your first, the easiest way to automate a trade. That's an automated trade right there. That's an algo trade. Enter position. It places both sides of the trade, and it does its thing. Okay. So, but more bang for the buck. If you want exposure to FANGs, you could do it here pretty cost effectively. Now, if you wanted to hold a position overnight, you want to hold a mini Nasdaq overnight, or a mini S&P, or gold, or silver, or Treasury bonds, or live cattle, or corn, or Aussie dollar, U.S. currency cross, any of them, and there's a lot of them, copper. Then the exchange publishes exchange minimum margins, and they're more than day trade margins for sure, but they still provide pretty good leverage on the position. All right, any questions yet? Let me know. I'm going to cancel this. Okay, don't let the bid-ask spread take all your money. In a lot of different markets, the bid-ask spread is a phenomenon that's here, right? It's the difference between the highest price somebody's willing to buy something from you and the lowest price somebody's willing to sell something to you, right? There's a spread there. There's a natural spread. If you want to sell your house for $1 million, someone might come in and say, "I'll buy it for $900,000," or whatever. I'm just using $1 million as a round number. Someone might come in and say, "I'll buy for." That's the bid-ask spread. The buyer wants it at 9. The seller wants it at $1 million. And then eventually that spread narrows until, boom, you have a deal, right? Now in futures trading, your spread is almost always one tick. Not always, but almost always, in the liquid markets anyway. It's one tick. It's as tight as it could be. And so that reduces your transaction cost as compared to some of the other markets where the bid-ask spread might be wider. ETFs, currencies, CFDs. If you're a CFD trader, you should be doing this. Again, my opinion, you should be doing this. I'm going to say your name wrong, and I apologize profusely. Gannicus? I'm going to say Gannicus. That's a cool name. Can you hedge in this platform? And the answer is yeah, absolutely. And remember, the platform is just an instrument for you to make a for you to make a trade. It's an instrument for you to make an investment. It's an instrument for you to hedge. And absolutely, if you wanted to, for whatever reason, you wanted to hedge something, maybe you own something and you're worried that the price is going to go down. Maybe let's take gold as the easiest thing. Let's say you have a closet full of gold bars, and you're worried that all this wealth you've accumulated in the gold. Maybe you feel that gold prices are going to go down, and you want to hedge to protect yourself so you could go ahead and sell a gold future. You could do the same thing with an equity. You could do the same thing with the equity. You have a 529 plan, your son's or daughter's for college fund, and you've built up an equity position in there, and you feel like we're going into a period of uncertainty or even a bear market, and you would want to sell to hedge your position in your 529 plan. So you could do that in the ES, the NQ, whatever your 529, however your 529 plan is weighted. So the answer is, yeah, you could absolutely hedge in these markets, and there a lot of people do, mostly institutions, but a lot of people do, and that's that's why the short selling concept is so empowering on the future side. Okay, so don't let the bid-ask spread take all of your profit. I mean, it's in this particular market, the E-mini S&P, the bid-ask spread, when it's one tick deep like it is now, it's worth $12.50 per contract. Okay, $12.50 per contract. The Nasdaq we saw was $5, traded in smaller increments. All right, everybody with me? All right, so we went through the bullet point list pretty much of why we're better here, why this is a better value proposition, why you should consider doing it. So let's just take a look at a chart and talk about technical analysis and strategies if you want to go long, or strategies if you want to go short. So let's just pull up a daily market in the E-mini S&P. And those are my lines I drew earlier. We're going to leave those. We're not going to leave those. Let's get rid of them. How do I do that? I'm going to go to my drawing tools, and I should have an option here that says clear drawings, and I do. All right, we're good. This market, what's the state of this market? Is this a sideways market? Is this a bull market? Is this actually? Let me go back further. Let's go back. Let's do a monthly chart. What's the state of this market? Well, I don't know about you, but in my mind, this is clearly a bull market, right? We're making all-time highs as we speak. The market's been in a bull market, this particular market, since 2008, right? Now, we've had some hiccups. We've had some corrections along the way, sure. But 2009, we'll say. We'll use 2009. We had the big meltdown. Everyone freaked out. But then we've been in a bull market ever since. Interest rate, 0% interest rate phenomenon has taken hold and has been instilled throughout the world, along with QE and stuff like that. And the result is this bull market. This, among other things, even to this day, the first thing I do is say, what's the state of the market? Now, throughout that whole 10-year bull period, you have times of reversal, right? This right here, I don't know what's the date here, July 29th, all the way to first week in August. Yeah, we had a reversal, we had a retracement, we had a correction. We lost a lot of ground. Then we went sideways, right? So we went from bear sideways to bull to correction to bull again. So if someone says, what's the state of the market? We're in a bull market. That's my opinion. That's my opinion. So there's two things you could do. You could either decide the bull market's going to continue and I want to take advantage of that. The trend is my friend, and I want to find places to buy an E-mini S&P on an intraday basis to take advantage of the upward velocity. Or you could say, you know what, we've gone high enough. I'm going to be a counter trend trader and look for places to sell the E-mini S&P. In my experience, it's better to go with the flow. It's better to go with the state of the market. Because there's long-term the underlying market here, don't forget, is the stock market, is corporate America. So that doesn't just stop in a day. So let's go ahead and take a look at a strategy on how to do this. So this is today's action, and we had I think probably some positive Chinese development on the whole tariff thing is my guess at what this is. I was preparing for the webinar, so I wasn't paying attention, but this was quite a significant rally, right? So this candle itself, let me just do this to make it easier for me. This candle itself, it had a low of 87, it had a high of 92. That's 5 handles. That's $50. That's $50 times 5. And then the rally continued on, right? So we have a nice picture. So I like to add basically an oscillator and a moving average. Let's do that. Let's go ahead and add an oscillator. I'm going to use the CCI. And remember, the CCI has a 0 line, and plus 100 is supposed to be overbought. Below minus 100 is supposed to be oversold. Right now we're 115. But the magic for the CCI in my mind happens during the crossover, when you cross from negative to positive. And what I'm going to do, what I'm going to do is I just want to color that line red to make it easier to see. So there's a cross right there. And so when you look for the cross and you get a pretty good velocity on that cross, that's a pretty good signal in my mind. We went from over negative 100 in 2 candles, and then another 2 candles to over positive 100. This is a really good signal. This is a really good thing to look at. Right now we don't have the benefit of that. The moving average cross, let's go ahead and add that. That's pretty easy. I'm going to simply go down to moving average, and I'm going to do something. I'm going to just do 26, and we'll keep it exponential, and we'll make it red. So this is my longer term moving average. It's 26 exponential, and then I want to add the cross. I'm going to add the second one, right? So I'm going to go back to moving average again, and then I'm going to make it a 6. And again, I know exponential. This is everybody's crosses. Everybody's moving average crosses are different and based on their own personal experience and based on their own personal trading method. This is just something that I'm setting up. Okay, so we have the short term diverging from the long term. 26 versus 6. And you could experiment with whether it's exponential or not, or whether it should be 6 or 8 or 10, and whether this should be 26 or 52 or 150. Whatever technique you want to come up with, you experiment with, you make your own, and you look for the signal. It's really easy to do with the Infinity AT charts. If you haven't downloaded these yet, it's web-based. There's nothing to download. You could do that for free for 30 days, real time, on our homepage. Highly recommend everybody give them a try. In any event, going back to this, so we're going to see, some crosses come in this period of time. 7:40 to 8:10 in the morning, pre-market I'd call it, and that corresponds with the CCI move. So this was a good signal, right? This was a good signal. In hindsight, It was a good signal. But now market's a little more mature, right? It's 9:49 in the morning. All the opening range activity has already occurred in the day, but I'm looking for places to go long. I want to go long now, and I want to be careful, and I want to have measured risk, right? I want to have measured risk. So I'm going to start thinking about where buyers and sellers gave up in the past. So let me just do a little. I think it's called not a line segment. There we go. And we're going to make it small. We'll make it white. So when I look at, oops, everything's moving on me. Sorry. Just draw a segment to these lows. I'm estimating. I mean, I'm not going to be perfect. So when I look at this formation, I'm looking for places to buy, and here we see we haven't had a transaction below 39.75 since the open at 8:30. Between 8:30 and 8:40. So that's telling me that nobody wants to do a transaction down here. This is a good place for a stop, right? This is a good place for a stop. But do you want to buy right now? We'd be buying at all-time highs if we just went long, right? So the beauty about future trading is we could be patient. We could be patient, and we could wait for a retracement back down toward what I would say is this area here. I turned off my drawing tool. I wonder if I could just clone this. Yeah, let me clone it, but these charts are so awesome. They're brand new. I learn every day. Let's see if I could move it. Instead of learning on your dime. Aha. Move it. So those were the highs up until this candle, right? So what I would suggest as a trade idea is we wait for a retracement below the breach of this high, right? We wait for retracement below, and our stop, remember, is down here a little bit south of 89. So the way the trade would look, if we were doing a one-lot trade, is we'd pick a number, I don't know, maybe 94. Wait for the market to come to us. It's a limit order, and then our stop would be down around 89. And I know what you're saying. Boy, this is a lot of risk, right? This is this is $250 risk. And it is. So if this isn't part of depending on your account size and depending on where your target is going to be, this might be too much risk for you, but it might not be. But just looking at the chart and deciding where the trade is, this is what I see. This is what I personally see. I want to be long. And actually, in the back of my head, I see 30. What was the high here today? High here was 96.5. How many people think we're going to hit 31 even psychologically? Is there a psychological 3100 even on here? Maybe. I don't know. I think there might be. But other things are pointing to the different direction, right? So right now, this candle has a really big wick, right? We're going to call it a wick. Some people refer to candle wicks as shadows. It has a high shadow on the top, which is a suggestion that sellers have come in and said, no more. We're taking over at least this time frame. The sellers have control, and they're pushing the market back down. But the bar isn't formed yet, so I'm not too worried about it. Another idea for those, if you're a little more brave than I am, is to say, hey, I don't mind if we trade in here because I'm comfortable where my stop is. I'm wrong at 89, right? I'm wrong. I'm just dead wrong at 89. So you wanted to give yourself a tick or two because you're worried about people picking off your stops, which I always have a hard time understanding. But if you wanted to be aggressive, you would say, all right, I'm going to go ahead and I want to buy a second unit somewhere in this retracement area, because eventually we're going to go back up again. So you could do that with the trading ladder, and let's just put a limit order in it at 1. Now, one thing obviously is wrong here is we only have a 1 lot stop. So we're long 1 contract. We want to buy another one here, and if that happens, this needs to be a 2. The stop needs to be 2 because I'll be plus 2. So I'm going to go ahead and do that. So now I'm plus 2. Even though I'm long 1 on the trading ladder, my stop is plus 2 because if the market goes down here, I'll be long 2 on the trading market. It's simple math. Okay, it's simple math. So now we have another decision to make. It's where we want our profit target. And when this bar stops forming, we're going to have what time is it now? We've got about 4 minutes left. We'll have a better idea of where we want a profit target. And for now, I'm just going to put one here. This is not as scientific as emotional. I'm going to put one here at the 3100 number. Okay, so that's the anatomy of this trade right now so far. If we were filled on the second order, right now our average price is on 1 lot is 1. It's 94, 30.94. If we bought a second one at 92, then our average price for the 2 lot would be 93. And then at that point, we'd probably look at peeling off a second unit somewhere between 94 and 97 or something. But we're not at that point yet, so we don't have to worry about that just yet. Is everybody following me? Any questions, any comments, ideas, things you'd like to say? If you have something on your mind. Yeah, no, all right, good question. So if you open up a Infinity AT account, of course you get this set up. And it's the platform, this part of it's free. There's no platform fee, there's no lifetime license, there's no, you don't have to mortgage your children unless you want to. But it's free. The charting part is also free for most traders, right? It's free for most traders because if you do 10 or more round turns in a 30-day period, which just about everybody does, it's not a high bar. Then it's free. Otherwise, it's $12 a month. So it's less than a tick in the E-mini S&P. It's not substantive. Small fee. But thanks for that question. Yeah, there's a lot of confusion on that. At the end of the day, the package itself isn't going to eat into your capital. You have our philosophy is you have enough stuff to worry about. This is tricky business. This is hard to do. It's hard to be successful. I'll be honest with you. But we'll try to make it as easy as possible. Yeah. So, all right, that's another good question. Yeah. So, what's considered a day trade versus a swing trade versus a position trade? Right now, we're in a day trade, right? So, definition of day trade is you open and close your position within the same trading day. Within the same trading day. Now, what's the trading day? Well, it just so happens that the market opened up last night at 5 p.m. It traded continuously all evening, past midnight, all morning, and all day to 4 p.m. this afternoon, 23 hours. That's the trading day. That's the same session. That's a day trade. If you bought one at 5:01 and then sold it at 3:59 the next afternoon, that's considered a day trade. Now, there's some folks would say, well, that's really a swing trade. What a day trade is, we're trying to do what I'm doing right here. is, within the next half an hour, 45 minutes, getting out of this trade and then putting on another one. Yeah, I mean, that's more of a traditional look at what a day trade is. But by definition, if you wanted your $500 day trade margin, you could put a position on at 5:01 at night and hold it until all the way at the end before the exchange minimum margins kick in. And I want to say the E-mini S&P exchange minimum margins are somewhere around $6,000. I can't remember per contract. So they're a good 10 times plus higher. But that's a good question. It's very confusing. In the equity in the cash markets, it's pretty straightforward, right? New York opens up at 8:30. You turn on your television and you watch whatever news station you're watching. They have an opening bell, and everyone's cheering and clapping, and you have a corporate sponsor up there on the podium, and it kicks off the day, right? 9:30 New York time. Then at the end of the day, the same thing happens in reverse, right? So at 3 o'clock, 4 o'clock New York time, you got people on the podium that are clapping, the bell's ringing, everyone's cheering, even though the market went down 700 points. They still cheer. But so that's a day trade there on the equity side, right? You know what it is. You have a defined period of time. It's traditional. It's based on tradition. Yeah, there is overnight trading in those markets, but it's more difficult to do. In this particular case, you got to think 23 hours a day, Sunday night until Friday. Then Saturday, you take an off day. So the other lesson that I wanted to point out on this particular trade that we're doing right here is, not a lot's happening, right? The market, the open is over. The next economic release, I think, was just released, but it was a natural gas number, I believe. At 9:30, we had the Energy Information Administration, part of the Department of Energy, released the weekly natural gas inventory number. That came out at 9:30. That affected the natural gas market, I'm sure, but there's not that type of planned thing going on right now. So you have the China stuff, you have stuff that's going on in Capitol Hill in the U.S., you have geopolitical events in the Middle East, you have Brexit going on in the Eurozone, and those kind of things could come up with a surprise at any given second, which could, of course, trigger some price action here. In the meantime, we're looking for a natural course of things. We're looking for the natural flow of the market. This is a bull market still. We're going to have a correction, and at some point and eventually there'll be a reversal, or a sideways market. We're not there yet, in my humble opinion. So now we're waiting. We're in wait mode. We're trying to be patient. And when people ask me, Jim, what's the number one thing? What's the number one rule? If you had 10 trading rules on how to be successful, what would be your number one rule? And I would say number one rule is patience, for a couple of different reasons. One, this is boring right now. We're right where we entered. We want some action. We want some P&L. We want something to happen here, and it's not. We're just hanging out and talking. So we're bored. Number two, there is a chemical process that happens in your brain which makes you want to do something. It makes you want to change your trade idea to something different than the analytics told you it should be. Maybe it's you want to buy another one right now. Maybe you want to buy another contract right now. Maybe you want to just get out at 94.50 and then buy it again when it bounces back down to 93.75. Maybe you want to reverse. So there's all these things that happen in your head that aren't based on the technical pattern of the chart or the fundamental analysis or news events that are percolating out there. These are things that you're making up and you don't even know it. You have no idea. You don't know it. So that's the hardest thing, is patience. You make a decision, you come up with a game plan, you implement the game plan, and you got to wait. Now, the corollary to that is things change, right? Momentum changes. You'll be able to literally, when you have enough experience doing this, you could see momentum changing. And you might decide that the trade idea is no longer valid and that you simply just want to get out of the trade. That's also a very valid thing. But right now I have a lot of risk associated with this trade, and 250. This is a $400 risk on this one lot trade idea. So that's got to be consistent with my account balance, with my method, and with my idea. I see a lot of folks, they just, at this point in the day, they just start adding studies and trying to find some other secret knowledge here that might change their mind or have them add to a position or something like that. But all this work should be done ahead of time before you even place a trade on the ladder. The other thing that's helpful, some people, this is kind of a preference advice kind of thing. I mean, looking at multiple markets, in my opinion, is a good thing. The other train of thought is just become an expert at one market. Just become an expert at one market. I think you could become an expert at more than one market. I mean, here's the Euro FX. That's the currency cross, right? We talked about. U.S. Treasury bonds, our market. This is a really nice market to trade. This is a little bit more advanced. The tick size is $31.25 to be more specific. So it's a little bit more, not for the faint of heart, but then again, it doesn't do so much of the gyrations that the mini Nasdaq does or some of the other ones. So it's a more constant, in my opinion, flow of prices. I'll put it that way. Gold is another very popular market. Look at COMEX gold. We see this nice bar. This is a nice risk-off bar, risk-off bar, risk-off bar, and it should, it kind of translated into the equity markets. The other market that we should probably talk about is crude oil. Crude oil is very popular. It's a little bit trickier to trade crude oil because of the inputs, right? So is it a supply market? Is it a demand market? You hear a lot of talk about OPEC, and you hear a lot of talk about Russia. You hear a lot of talk about South America, oil flows, rig counts, supply and demand. But you also have other economic fundamentals that drive the price of crude oil. So there's a lot more data to consider and a lot more inputs and outputs. And geopolitical events really can mess this up also as well. So, but it's a great market to trade. It's very liquid. It's very popular. Again, it's a futures market. And there's 5 different asset classes that I would talk about, that I would suggest people look at. The traditional ones are the grain markets, right? Corn, soybeans, soy meals, oats, all that. That's what started this whole thing at the turn of the century. Was farmers, was the grain business. It was big business, and it still is big business. But it's kind of that's the cornerstone, the fundamental beginning of futures trading. Chicago Board of Trade. This is where it all started. The other instruments weren't added till later. Stock indexes weren't added till later. Treasury bonds weren't added till, I don't know, early 70s. I think the S&P was the 80s, right? Or no, maybe the late 70s. So you've had over a half a century of futures trading phenomenon, and analysis and techniques and books written from people that, Jesse Livermore, still has some principles that are very valid. A lot of the analysis and studies you see here are very old. There's a lot of new stuff here, but there's some old stuff as well. On the AT charts themselves, you have a whole bunch of customized indicators here that you could choose from. Research them, test them in sim mode, test them with a small account. Actually, let me show you a small test account. Let's go to I'd be remiss if I didn't show this. Here's the micro. Exact same market as the E-mini S&P, except it's got an M in front of it. For micro, it's 1/10 the size. So instead of $12.50 a tick, it's $1.25 a tick. So my opinion of the micros is no one's going to get rich trading them. The tick size is too small in my opinion. However, great place to test your technical analysis strategies. Great place to test your, which indicators work for you. Great place to transition from sim trading, you've never traded futures before, to a trading ladder, a live trading ladder with real money, with real psychological effects. So the micros are another good thing. Again, I don't think anyone's going to get rich, and no one's going to get poor either trading them. I don't think, if you're doing 1 lots or 2 lots or 3 lots. So it's 1/10 the size, exact same market, and you can see the prices are in sync. You can see the prices are in sync. They might deviate here and there a little bit short term, but they get arbitraged and they are in sync. Okay, what else do we have to talk about? We're about to get a second unit here. And this is when you really start sweating. We're only down 75 bucks right now, so I'm not too worried. But, what I just said was bad. Don't trade the P&L. Trade the lines on the charts. Trade the candles. So looking back at this this candle right here, it has a pretty big shadow at the top, pretty big wick at the top. No wick at the bottom. Now, this is saying sellers took over and said, no, we're not trading this high today, or at least right now, which does not bode for our position, does not bode well for our position. But the good news is the head, the body of this candle is relatively big. I'm going to eyeball it and say it's over 33%. So that might be okay. That might be okay. So again, I wouldn't change my mind right now. I'd stay where I'm at in this particular trade idea. All right, so it's 11 minutes after 10. We're going to go ahead and start wrapping it up. Any last second questions? Michael had a question about the CCI crossover. So I think you got to look at, all right, one thing I didn't teach you. When I look at a chart, a 10-minute chart, and a 10-minute chart, and I'm going to teach you 2 things here. 10-minute chart, I'm going to also add what's called the super trend. Super trend's on the drop down, and the super trend triggered way back here. What was that, midnight? Around midnight, the super trend triggered long, right? And it continued. It hasn't changed. This green line represents where the super trend, I think, tells you your stop should be. And it's a longer term indicator on a 10-minute chart. So that's kind of number 1. Number 2, I look for the moving average cross, short going over long. That's the second indicator. And the third one is when the CCI crosses over 0. So Michael, when I see these 3 things in action, that's triple confirmation, and it helps me feel like we should go long. If 2 out of 3 are true, I'm a little hazy. If 1 out of 3 are true, no. And again, my bias is long, so really in no circumstance, or in rare circumstances, am I going to try to sell something. Because I'm going with the bias. The bias is bullish until proven otherwise, until we turn sideways, until we have a retracement. So we have some recognizable thing on a day chart where I could say, okay, there's going to be a retracement here. So yeah, so I wouldn't say this crossover in among itself is the signal, but it's a contributor. And the other thing that's important is when you see the velocity of the crossover, here's a crossover here. You didn't go from a big positive number within a couple of bars to cross under. In this particular case, we were oversold, minus 100. And I'm using the nomenclature that the CCI uses. And we went from a negative 100 plus state within 2 bars to 0, within another 2 bars to over. So the velocity of this transition was pretty good. That also helps me with the validity of the signal. And I've seen all 3 signals look really good, and the trade didn't work. I mean, that's also possible as well. But those are the 3 things: an oscillator, moving average cross, and if you have a specialty thing like the super trend, I think you're in good shape. And then look, and then try to read the candles. Try to read the candles. We're looking for gravestone dojis. We're looking for turnaround dojis. We're looking for shooting stars and hammers. Those kind of things. That's a whole nother webinar. We don't have time for all that. Let's see. Someone asked. Rick is asking about the charting options. Yeah, there's, this particular charting option is AT charts is this is our internal offering. You could trade mobily, chart mobily. I didn't even talk about the trading aspects. It's totally in sync with the trading ladder. So let me just show you what I mean here. So these trades here are going to mirror here. And when you move something, I'm just going to move this order for a second. I'm going to cancel and place it down here. And you can see on the chart, it's 100% in sync. Cancel, replace, 100% in sync. As a matter of fact, you don't even have to have the trading ladder open, and you could just go log into the charts themselves and trade from the charts. There's the buy orders. You just adjust them by dragging. Sell orders, just adjust them by dragging. Up above is limit, down below is a stop. Market order, whatever you want to do. So we didn't talk about that today. Maybe we should do a whole webinar on that. But this is our internal offering. Third-party charting platforms are still welcome at Infinity. We do have a traditional relationship with Sierra, is what you're asking about, Rick, and we're still integrated with that. My understanding is the technology folks are constantly working to keep that data feed really good. You got to ignore all the BS on their chat, their message boards. I mean, you get a lot of stuff from the same 3 people talking crazy. But Sierra is still a very valid choice. We have, let me point out, Trade Navigator, Ensign, and then we have this new thing. It's not a new thing, but a renewed interest in Able Trend. This is really a signal program, which works with the Infinity AT trading ladder really well. Able Trend's been around for a long time, and if you're interested in a signal, it's more of a signal program based on a system that our friends at Able Trend have been developing for a long time, and they've been in business a long time. We've seen a lot of systems and a lot of signals since I started here in 2001 come and go. Able Trend's met the test of time. They've outlived us. They've been around longer than us. So this is another thing that's integrated with us. So yeah, whatever charts you want, we don't care. Our thing is transactions. Our thing is trading ladder, and then the integration on the web and mobile. So Rick, hopefully that helps. And if you need help with installing or configuring any of those other third-party options, let us know. We're pretty good at that. We have a pretty good stable of support folks here at Infinity. Okay, so Joe says, what is join? I'm sorry, I'm answering your question so late, Joe. Join the bid, join the offer. Let's go to a market that's not moving so fast, so I could demonstrate that. Here's the Treasury bond market. And by the way, now that we're here, I mean, look at the bid ask, look at the volume on the bid and ask on Treasury bonds. Pretty good, huh? All right. So if I want to join the bid, it's going to place a limit order at the highest bid, which is 56.28. Right? 56.28. It's the highest bid. I'm joining the bid. If I want to join the offer, it's going to place a trade at the lowest offer, which is 29. Join the offer. Okay, it's placed a limit order at the offer right now, and this is a simulator, so I'll eventually get filled, and I did. Okay, and remember, the market is it's either trading on the bid or it's trading on the offer. It's either trading on the highest buyer's level, or it's trading on the lowest seller's offer. Lowest seller's level. So so when people say, for instance, 28 bid at 29, or if you're in the pit, you say 8 bid at 9, 8 bid at 9, 8 bid at 9. That would say that would tell you what the bid-ask spread is. And right now we're trading on the bid. We're trading at 28. Okay, so all as the join the bid and join the offer does is try to get you as close to the market as possible without being a market order. Some people find that handy, and actually I think it is handy, especially in markets that let's just take the mini NASDAQ as an example. In the mini NASDAQ market, it bounces around a lot. Crude oil does that too sometimes. Now again, it's a slower part of the day. We're almost at lunchtime in New York. But if you want to gain one extra tick here, you're going to join the bid or join the offer, right? So you join the bid, and it puts you there. Now your risk is you don't get filled, like I just didn't. But maybe you do get filled. So the risk is you don't get filled. The benefits are that you beat the bid-ask spread by one tick. You got in at a better price than just going, as compared to going market in most cases. Does that make sense? Hopefully that makes a little more sense. All right, let's get out of here. All right, why did I just lose my question box again? Hang on a second, guys. We're almost done. We're almost done. Any last second questions, definitely type them in because we're going to wrap it up. Well, the notional value, when you think about the Euro FX contract, it's a $125,000 contract. I know in Forex, in cash Forex, you have a $100,000 or a $10,000 contract. This particular market is a $120,000 contract. And that's true for not all, but most of the currencies. All right, I think I got everything nailed here on questions and answers. And let me just, well, maybe not. Someone did ask for the AbleTrend integration earlier today. So the best thing to do, if you want to try AbleTrend, if you want to go AbleTrend route, which is awesome. I mean, it's awesome that you want to try it, and hopefully it does well for you. Yeah, just you could either do one of two things. Call your customer service rep. We'll get you set up right away. Call me, Jim Kignina, or just send me an email at trade@infinityfutures.com. We work with Ron over at AbleSys pretty closely, and we'll be able to get you set up that day. They do charge for their demos, but you get a lot of support with that. You get a lot of support and help with that. So I would consider, if it's a live account, even better. I'd consider that. You could talk to them, go to their website. Okay, where do I see? Why is my question box so funky? Hang on a second, everybody. There's a couple other questions here that I think merit some. Well, all the questions are legit, but let me get to. Bear with me here, guys. Someone's saying we added a 2-hour. Okay, yeah, we did add it. We added a 2-hour option here on the charts. Absolutely. What about pivot points? You could do. There's pivot points on here. There's daily pivots, in similar types of. Where's my pivot point at? Probably starts with a P. There's pivots, and you could configure those however you want. Maybe refresh, but yeah, absolutely. Go through this list of studies, either in your live account or your demo account, and you'll be able to see, a couple of things here that aren't I didn't talk about. CCIMI is one of my things that I put up. It's basically a moving average cross combo. Daily open, high, low, close. This is what's new. MPD indicator. This is Patrick Zielbauer's kind of proprietary take on things. It's pretty cool. He's got a YouTube video on it on our YouTube channel. Tick and trend. For those of you guys who follow Tick and Trend, New York Stock Exchange internals. Here's pivot. Here's a more modified version of the pivot points. Previous open, high, low, close. In addition to daily open, high, low, close. And slow stochastics. Price profile plus. This is really market profile. Actually, let me show you this, but I'm going to show you this in a different browser. Hang on a second. This is super cool. I'm going to do this just so I don't mess up my setup. I'm going to open up a second browser in incognito mode so I don't mess up my settings. So let's just pick ES. And now we're going into triple overtime. I'm going to get there in a second. Let's change it to 30. Let's go to price profile plus. This is market profile, by the way. Price. There we go. And there we have a market profile, which is configurable. Let me hit refresh one more time. Let's give it a second. When you get up to the studies here, I had to refresh, but when you get up to the studies here, you go to price profile plus. It gives you a window. You could change the brick heights, the start time. You know, I like to start at 2 o'clock. And panel is a chart. Sorry. Now, if you want the number bars or you want this thing flattened out, you click on the number bars button there. And then you could basically have the market, market profiles spread out. And then it's going to start generating number bars. The historical data is not there yet. We're working on that. But bear with us. You'll get that. So this is market profile spread out into basically candles, if you think about it. And then number bars are going to populate here going forward. This stuff will be shot in the back. You know, it'll eventually fill backward. Anyway, that's kind of cool. Let me get rid of some of this stuff here. Let's get rid of pivots. We'll leave the rest there. UXDX. I'm not sure what you mean by that, Don. Okay, what is reverse and flatten? I'm not a fan of reverse, but I am a fan of flatten. So I'm just going to put a bunch of orders in, and let's say you're just trading. You got a bunch of orders in, and you want to flatten your position. You don't want to be long anymore. You want to flatten your position, and you want to cancel all these orders at the same time. You don't want to have to go and right-click on each one individually. Maybe you'll miss one that's a little bit lower on the dome. Click flatten, and it flattens your position and cancels all your stuff. Okay, it's kind of like a panic button. If you think of flatten like a panic button, that's what it is. Flattens everything, cancels anything that's working. The reverse is exactly what it says, and I'm not a fan because it means you don't have a strategy. So if I'm long one and I hit the reverse button, it's going to sell two at the market. So it'll close the long position, and then I'll be short one. So in my experience, I mean, that's a great commission generator for me, but it's not a great strategy for you. So use the reverse button gingerly. Okay, in the heat of the battle, something changes. You want to make a move. you know, something unexpected happens and you need to make a move the other direction, it's okay. But use the reverse thing gingerly. Okay, and then cancel. Just what cancel does, cancel all. It doesn't mess with your position. It just cancels all your working orders. Cancels all your limits and stops. That's what that does. So what I always do routinely, I always hit cancel all or flatten when I'm not done with the trade, just in case I didn't miss an order way up high or way up low. Just best practices. Always good to do. Okay. I think we got all the questions. The cost, or one more. Joe says, what could I say list of all the markets and the tick costs for each? I think maybe we have it on our website somewhere. Let's go to sitemap. Let's go to, let's see. We used to have a thing called contract specs. I know it's on here. Maybe it didn't make the sitemap. Let's just see. Trading. Oh, here's a margins page. Let's see what we got there. Okay, that's the day trade margins. More about margins. Oh, that's a pretty cool video you could watch by the CME group. I could send you one, Joe. In the meantime, we'll get it put back up here on the website. We did redesign the website, and maybe I'm just not seeing it, but there's a place here that's called contract specs. I'll get that back up for you, or I'll email it. I'll email it to you. Yeah, sorry about that. There's a place I have it, Joe. I'll get it to you. I'll get it to you. Sherry asks, what's a super trend chart? It's not a super trend chart. It's a super trend indicator, and you just simply add it the way I showed on the chart. You could do, you know, there's an equation behind it. You could probably Google it, or send me an email. I'll find it for you and send it to you. All right, last thing I want to point out, if you haven't already, free practice account, fill this out. You're going to get a username and password and a download link immediately upon hitting the get started button. So if you fake us out on first name, last name, and phone number, you'll at least make the email work, because that's where you're going to get your stuff. All right, and try it. And you know, if you want to schedule a one-on-one with any of the reps or myself, be happy to talk to you about setup, how to use it, how to integrate it. All that stuff's pretty cool. And that's where I would start. YouTube channel, you want to get to that. A lot of cool videos there, especially by Patrick, some by me, some by Marcus. Way at the bottom here, you see the little YouTube button here. You click on that. It will shoot you out to the YouTube channel where we post new videos here all the time. If you want to subscribe, you're going to get an email from us or from YouTube whenever there's a new video. There's usually 1 or 2 or 3 a week. Here's the different channels there. Tip of the week by Marcus Zielbauer, pretty good if you're actually, you know, working with the software. How to use the DOM, all the tricks I just went over. Patrick's Corner, the other Zielbauer here, the Zielbauer boys. He does some pretty good comparisons, analysis, techniques videos that are really good. And then some Sierra stuff, and then AbleSys. We're starting an AbleSys playlist again, and then some archived webinars. Where today's webinar will be here, right down there, and that's what we got. So I want to remind everybody, trading futures, options and futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility, although this could be an equation for opportunity. It's also an equation for risk. So I'll just leave that up there for everybody to see. And let's just take a look at our trade here. Things are, hang on a second there, people. This is like the extra trailer that you get when you watch a Marvel comic movie right now. Here's the extra trailer. Let's pick a second target now that we got filled on a 2 lot. Okay, remember our trade. Remember our trade. We were long one at 94. We bought another one at 92. Our average price now is 93. So we're long two at 93. We had a target way up here at 31 even, right? Just to have one in. And we have a stop down here at 89. So at this particular junction, what I would strongly like to do is I would like to get out of one of the units on the upside, right? And my instincts always go 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 6, and put a limit order there. Now I have time to figure out what if this was a random 6 or I want to change it. But at least I have something in, right? I have something in right here. And if we shoot up again, I'm going to go from +2 to +1 because I'm going to sell one of the two open positions. And then I'm going to have to change my stop. But at least I'll lock in some P&L. At least I'll lock in some P&L. Then I could adjust the stop level if I want. Then I could adjust the stop level if I want. So looking at the candles, and thinking that we're going to go ahead and approach this, I don't know if you want to call it a shelf or the segment I draw, and breach that again is a reasonable place to be, then we're pretty close on our 6 ticks. We're pretty close on our 6 ticks. So I'd probably leave it there. If I was more aggressive, I'd put it up higher, but I would leave it there. If we get filled here, you're going to change this 2 lot to a 1 lot, and we're going to move the remaining 1 lot stop higher. Okay. So that's the extra trailer, Marvel comic trailer. Thanks everybody. I'm going to go ahead and sign off right now. Be careful out there. Good luck, and hopefully we're going to have another webinar in a couple weeks. We'll go over it again. Take care.